Okay, everything if you're a Tesla investor. The next few minutes of this video may give you a reason to once again reevaluate your investment and assess what exactly it is you're investing in. If you have a price target on Tesla of 215 after yesterday's results, does that change at all? I gradually lowered my fair value estimates to 215 to 2 from 225 due to slightly lower margins, as I was anticipating that will likely persist through 2023. So, Elon Musk is trying to reassure everyone that this price war will work out in the long run. Do you agree with him? If he keeps cutting prices, will Tesla actually gain market share? Operating margins for the company, which CFOs who perform focus on, fell to 11 in the first quarter of this year, which was lower than what I had anticipated. I had assumed that operating margins would be at 13 or 14 for the year, which was still at 2 or 3% compression from the previous year. But because of price cuts and the ongoing price test Tesla cut earlier this month, I think that lower margins will likely persist throughout the year. More importantly, though, if you look over the long term, I've seen really no changes. While the Tesla story indicates that the company will be pursuing a volume over price strategy this year, the growth story is still very much intact. Yesterday, we learned that the real key metric there was the gross auto margin of 20.5%, which was the estimate. The fact that it fails by a significant amount below that suggests that the margin number is likely to continue declining over time, which will likely shape the story's narrative. In the long run, I believe Tesla will be able to return to the 29 automotive gross margin that they achieved over the previous 2 years. It is expected to decline to the low 20, and it will stay there for the remainder of this year and next year. However, I believe that margins will gradually increase as they ramp up production of new vehicles and as their cost production strategies, which were outlined during the Investor Day earlier this year, take hold. In a manner, every ardent Tesla supporter harbors visions of what Tesla might become in the near future. Elon Musk, the CEO of Tesla, believes the company will eventually be worth more than the combined value of Apple and Saudi Aramco. By 2027, Cathie Wood anticipates that the price of a Tesla share will reach $2,000. She believes that Tesla will bull, although there's still room for skepticism. Gary Black thinks that Tesla's Cybertruck will be a game changer for the company. No business can function without facing problems of its own. Even while Tesla seems to be handling its problems rather well, things might not stay this way in the future. Hi everyone, happy to be back at Tesla tomorrow. Thoughts of improving times caused investors to dump Tesla's stock price once more below 200. Investors are unsure about what precisely they are investing in as a result of Tesla's most recent adjustments to its delivery and price policies. The recent decline in Tesla's profit margin is one area in which this question is becoming more and more pertinent. While it was anticipated that price reductions would increase demand, profit margins are also being impacted, and many analysts believe that Tesla is likely becoming the victim of this price war. Might this be accurate? Let's find out, but first, in order to stay updated on all things Tesla, please hit the like, subscribe, and turn on notifications buttons if you enjoy this kind of stuff. Recently, hours after its shares dropped due to worries that its aggressive price-cutting strategy was eating into earnings, Tesla increased the price of 2 of its most costly models in the United States. The manufacturer of electric vehicles, EVs, has been lowering prices in the U.S. this year to stimulate demand and assist staff its plants in Shanghai, Texas, California, and Germany. Fears of a wider pricing war in the electric vehicle market have been aroused by this move. A few weeks ago, traditional automobile makers' already meager profit margins on their battery versions were under pressure from knockouts. For the first quarter of 2023, Tesla published its financial results and shareholder letter. For this quarter, Wall Street was expecting sales of $23.617 billion and profits per share of 85 cents. Tesla, however, disclosed its financial data and verified that, while missing revenue by about $300 million, it was able to exceed earnings projections of 85 cents per share. In the first quarter of 2023, they reported revenue of $23.3 billion, which was below than the forecast of Wall Street by about $300 million, although meeting earnings projections. While the revenue amount for Q1 is slightly lower than the $24.32 billion that Tesla announced in Q4, it is still $24 billion greater than the profitability figure from a year ago. Adjusted net income for Tesla was $2.9 billion, which was less than the $3.03 billion street expectation, and $1 billion less than the previous quarter. According to Tesla's reports, profit decreased but revenue remained same. This suggests that margin compression may be at work in this situation, but let's wait and see what analysts have to say. Price reductions and their impact on Tesla's and other EV manufacturers' profitability have caused Ryan Brinkman of JP Morgan to be cautious. Play primarily a car company, but rather a tech company that will lead the way in autonomous driving and create the next generation batteries that its competitors will use. Instead, he thinks that the influx of new, largely low-cost models from all of the major competitors will significantly reduce Tesla's profitability in the future. It's all about numbers. First, figuring out how much Tesla's future earnings must match in order to maintain its existing cap. Second, determining its actual value by using realistic sales and profit estimates. The trainer provides his estimates in a new study, which demonstrates Tesla's failure to meet both requirements. According to China's most likely scenario, Tesla will grow significantly in the next years, but its profit margin would only marginally exceed what it is already recording. The surge of inexpensive EVs competing for the same clients, in his opinion, will be the primary obstacle. He predicts that Tesla will grow its sales quickly, averaging between 20 and 30 per year in 2023, 24, and 25, and 10 in the next 5 years, provided it can continue to be a fantastic company. China contends that our pricing policy will be the reason for Tesla's demise because the stock, which is supported by compelling reasoning, is bound for catastrophe. What the automakers have to say should be heard. In the shareholder letter, Tesla outlined its price plan. It said that, given the potential lifetime value of its vehicles through autonomy, supercharging connectivity, and service, its near-term pricing strategy takes a long-term view on per-vehicle probability and profitability. Speaking in terms of gross margin, the automaker states that it anticipates that the price of its products will continue to change, either upward or downward, based on several circumstances. Tesla claimed that even though it decreased prices for a number of car models in various markets during the first quarter, the pace at which its operating margins were lowered was reasonable. It further stated that as the business grows, it will continue to focus on operating leverage and anticipate continuous cost reductions for its vehicles, including increased production efficiency at its newest factories and lower liturgical prices. In order to increase market share, Tesla CEO Elon Musk also said that the business was willing to accept smaller profit margins in the future. No pricing war is being started by Tesla. According to the Tesla CEO, the company is just cutting prices to achieve affordability on a large scale. During a conference call to discuss the company's profits, Tesla stated that overall revenue in the first 3 months of the year increased to $23.3 billion, up 24% from the same period last year due to an increase in car sales. Musk claimed that he made the best decision for Tesla by chasing higher sales at a lower profit margin. Musk informed investors that Tesla is the most profitable electric vehicle manufacturer and that long-term profitability would continue to be high. Elon Musk also mentioned the possibility of increased profits for Tesla following the sale of vehicles equipped with technologies like self-driving, supercharging, and other subscription-based services. Musk thinks Tesla is still in the early stages of building the foundation and anticipates that the company will continue to have the highest earnings in the sector. According to him, it is preferable for Tesla to ship a big number of vehicles at a reduced profit and then later take that profit back. Tom Nayan, an analyst with RBC, concurs. Long-term, he said, he thinks Tesla's price reductions are a smart move that capitalizes on their cost leadership, but it's not without a cost as margins will probably worsen before improving. The fact that Tesla maintained industry-leading gross margins on its automotive division in spite of pricing reductions earlier this quarter may perhaps be the biggest story. But what are your thoughts? Tell us what you think Tesla is worth in the comments section below. Please click on the following video to see more about what Tesla has been up to in the previous few days.